The IRS received $80 billion in funding when President Biden signed the Inflation Reduction Act last year. More than $45 billion has been earmarked for enforcement, making some taxpayers nervous that could mean more audits. So I want to bring in Ryan Losey to explain what triggers an audit. He's a CPA and the executive vice president of the certified public accounting firm Piascik, which is based in Virginia. Thanks for joining us this morning. So first off, what does an increased number of IRS agents actually mean for the average taxpayer?
I think it's not going to mean much of a change unless those average taxpayers have been dabbling in crypto and haven't reported that in the past years, or have a side hustle.
Okay, so that's good. Well, but a lot of people, at least a lot of people, seem to have side hustles. I'm always trying to figure out what my side hustle could be. So then let's talk about this. What's likely to trigger an audit? What are agents looking at? I guess you just mentioned two things that might jump out at them.
Sure. So a couple of areas that are of focus. The higher the adjusted gross income, that's always been an indicator. So if your income's over 10 million, you're in a much greater class of audit risk. If you're over $1 million, again, it's less, but more than the average. When it starts getting under 250,000, the chances start getting less than 1%. Now, if there are items on your tax return that could draw scrutiny, they're typically large deductions that are claimed, either business deductions from like a sole proprietorship, or it could be large deductions that are claimed as an itemized deduction that for some reason are outliers with respect to your income band that the IRS uses from a trend analysis.
So when you say a large deduction, I mean, are we talking about, $100,000? Are we talking about $10,000? Or are we talking about $2,000? What kind of stands out as a large deduction?
Well, again, I mentioned the income band. So if your income is in the $50,000 range, but you happen to have a charitable deduction of $100,000, that might jump out at the IRS, and they may want actual substantiation of that, as opposed to just taking the return as prepared.
Right. Okay, so then when it comes to substantiation, what sort of records should you be keeping? And then, how long do you have to keep these records?
So our firm tells clients 7 years, and that's typically 6 past years and then add on the current year. And there's some reasons for that. Typically, there's a 3-year statute of limitations. That's the general rule. But if there's a material or what's called a gross understatement of income, which is basically 25% or more, the IRS can expand that statute to audit returns up to 6 years. So if you add 6 years in the past plus 1 year, that's 7 years.
What is the biggest mistake that you see people make when they are informed that they're going to be audited?
The biggest mistake is not doing anything. That is the worst thing you can do. It'll cause more problems than if you otherwise responded.
Right.
The other thing I would mention is just because you've been sent a letter indicating you're pulled for examination, that does not mean your world is going to come down at that end.
It does. I mean, you hear the word audit, immediately you grow an ulcer, you get a migraine, you're sweating. You always feel like it's going to be the worst case scenario. Maybe they'll find money that they're owed to you. You never know. All right. Ryan Losey, thank you very much.
Pleased to be here. Thank you.
This Money Watch segment has been brought to you by Merrill, a Bank of America company. What would you like the power to do?